So now that we have our graphs, first thing we do is label them. So take a second and label these cost curves. We know which one is which because we can recognize their shape. Now the other thing I'm going to do is add some numbers because we want to get into the decision as to how much we are willing and able to sell. So let's put some numbers here. 5, 10, 15, 20, 25, 30, 35, 40. Okay, and then on the bottom here, let's do, 20, 25, 30, 35, 40, 45, 50, 60, 70, 80, 90, 100, 10, 20, 30. All right, so we've added some numbers, some scale to our graphs. Now let's start looking at some decisions. We are going to start by assuming that we are in a competitive market. In a competitive market, businesses are price takers. They take the price as given. So an individual business does not have the ability to set the market price. We're going to look over the next couple weeks at markets that are monopolies and oligopolies, monopolistic competition. In these markets, businesses have more market power. They're able to have some influence over the price. But we'll start with the perfectly competitive market. That is, all of the goods provided by all the companies are the same. You can't tell who made what, and so customers are purchasing solely based on price, and the price is set by supply and demand. So each individual firm is a price taker. It can sell at the market price. Okay, so if the price is set by the market, we take it as given, and let's assume in this case that the market price is $35. So then this company has a decision to make. If we can sell our product for $35, because that's what everybody else is doing, how many would we be willing and able to sell? So we start here and we think, how do I decide how much quantity I'm willing and able to sell? Well, this comes back to the discussion we had at the very beginning of the semester, which is how does anyone make decisions? You make decisions by doing what? By weighing the costs and the benefits, and you do things when the extra benefit is more than the extra cost, you do it. So as a business, what is the extra benefit of selling one more unit? Well, the extra benefit here, is the price that you can sell it for. So the extra benefit of selling one more is the money I bring in from selling it, which is the price. And then we want to compare that extra benefit to the extra cost. Well, it just so happens we have a graph here that shows us the extra cost. So we want to compare the price to the marginal cost. Well, here if the price is $35 and the extra cost here is about $12, then we get to sell it for a lot more than it costs to make it. So we sell one item for $35. The extra cost to make that one item is about $12. The price is more than the marginal cost. The extra benefit is more than the marginal cost. We do it. So we keep going and we sell more. Here we can see the price is $35. The extra cost is about $26. And so what we see is that the extra benefit is more than the extra cost. So we keep doing it. Well, when we get over here, let's see, what are we, about 110 units. We can see here that at a price of $35, the extra cost is more than $35. So if the extra cost is more than the extra benefit, and you are rational according to economics, then we should do what? We should not do it. We should do less of it. So where do we stop? When we're trying to decide how much to produce, we are going to produce until when? If the marginal benefit's more than the marginal cost, we're going to make more. If the marginal cost is more than the marginal benefit, we're going to make less. And we're going to stop when what? When price equals marginal cost. When the marginal benefit equals the marginal cost. So where is that on this graph? That happens right here. And because I can never draw straight lines, we'll connect it down. And what do we see? That's about, what, 105? So if the price in the market is 35 bucks, then the quantity we would be willing and able to sell as a business is this quantity here at 105. Okay. So we're going to sell 105 units at 35 bucks a piece. Well, how much total revenue, how much total money coming in will we make? So how do we calculate total revenue? We've talked about this before. Total revenue is equal to price times quantity. So the total revenue from selling 105 units at 35 bucks a piece is 35 times 105. 35 times 105, which is $36.75. So in this example, our total revenue is $3,675. Then the question is, how much profit are we making? Well, how do we figure out our profit? Well, we could look at total revenue minus total cost. That's one way to get profit. We can also see profit on the graph. So we know we're making 105 units. And if we're making 105 units, we can figure out the cost per unit. Okay, so how do we figure out this cost per unit? Well, we would go down to our average total cost. So at 105 units, and again, I'm going to draw a line here because it's hard for me to get straight. So we can see if we're making 105 units, the cost per unit is, what are we saying? That's about 23? Okay. So let's put this at 23. So to find out how much profit we're making, we want to compare the price to the cost per unit. And we want to recognize that that difference between the price and the cost per unit, we're going to make off of all of the units that we make and sell. So to find our profit, we're going to take our price of 35, subtract the per unit cost of 23, and multiply that times the number of units, 105. So we pull out our calculator again, 35 minus 23. So we're making profit per unit at $12, okay? And we're making that $12 for all 105 units. So our profit here is $12.60. Now, in economic profit, we include both the explicit cost and the implicit cost. These graphs here show our explicit costs, right? We looked at fixed and variable. And we're assuming here that they also take into consideration that implicit cost and the fact that we are making profit. When we talk about economic cost, right, we're including both the dollars and we're including that implicit cost or that opportunity cost, the trade-off. So when we talk about economic profit, We're talking about the fact that we're making more money doing this than the next best alternative. So we're using this calculation here between the price and the average cost per unit at our quantity as an approximation of that economic profit. That we are covering that explicit costs and we're making more profit at this than the next best alternative. So it seems good, right? We're going to produce 105 units. We're going to sell at a price of $35. It looks like it's profitable. The question becomes, at what price, because we're a price taker, would we just break even? Where would our economic profit be zero? That is, we're covering the explicit costs, but we're not doing better at this than we are anything else. And where is the shutdown price? That is, where is the price at which we are better off closing the doors and going home? So we need to figure out these ideas of break even and shutdown. The other thing we want to figure out is the quantity called economic capacity. Okay, so this is the capacity, the quantity we're producing at where the business is the most efficient. So let's dive into these definitions and then we'll go back to our example. So we talked before about the shapes of the different curves. And we know that there's a relationship between the curves and productivity. So, for example, the average variable cost curve is U-shaped because average product is an upside down U. And we can look at the average productivity to determine when our workers are the most productive, right? We're getting the most from our workers when the typical worker makes the most. So average productivity is at its max. Well, when average productivity is at its max, we're getting the most per worker. That's when the average variable cost, so the cost per worker spread across the number of units, is going to be at its lowest. So if the typical worker makes the most amount of units, then the cost of that worker can be spread across those units. So the average variable cost is at its minimum when the average product is at its maximum. This is when the worker is the most productive. But what about the business in total? When is the business its most efficient? When is its cost per unit the lowest? When are we getting the most bang for our buck? Well, to that, we look at the average total cost. Remember, the average total cost includes both the variable and the fixed. So it considers not only the productivity of the worker, but the fact that we have to take our fixed costs and spread it across the number of units. So when we find this point, that minimum average total cost, this is going to be where the business is the most efficient. So yes, it takes into consideration when the workers are the most productive, but we also have to consider that we have to spread out that fixed cost. So notice that it's past the point where the workers are the most productive because we're spreading out more of that fixed cost. This quantity has a name. It is called economic capacity. The economic capacity is the quantity at which the business is the most efficient. This is where you're at your minimum average total cost. And we know we're at our minimum average total cost because this is where marginal cost intersects the average. If the marginal is below the average, it pulls it down. If the marginal is above the average, it pulls it up. The economic capacity is about 80% of physical capacity. So you think about, you have a warehouse or a manufacturing plant. Okay. If we use that manufacturing plant all the time, 24/7, building full, always running, okay, that would be 100% of physical capacity. In fact, if we're running multiple shifts, more than it's designed to, so we're not going down for maintenance, then we're actually running at more than 100% capacity. We'll talk about that in operations management. But if we look at what the building was designed for, what the space or process was designed for, that's physical capacity. Now, why don't we run at 100% physical capacity? Why don't we have everyone working, machines running all the time? Well, we do need to have downtime for maintenance. We need to change over between product lines. There are things that need to be done in our production process that are advantageous. We don't want to run 24/7 because then our machines are more likely to break. We want to have that downtime, that maintenance. We don't want to work our people 24/7. They need breaks, right? So we have a limited shift. We have mandated break time. This is so that they are at their peak ability. They're able to be as productive as they can be. So we don't want to run at 100% capacity. So the optimal is about 80% of physical capacity for most operations. This is where you have considered the quantity that is your workers the most productive, but then you're also spreading out that fixed cost. So that's this economic capacity. If we go back to our example that we were looking at here, can you find economic capacity? What is the quantity at which this business is the most efficient? Where would that occur? Okay, and so we look for that minimum average total cost. And we can see that, here? Okay, and economic capacity is a quantity. So I'm just going to draw a line down so we can figure out what that quantity is. All right, so we're looking at about 82 here is our economic capacity. So this is the quantity where this business would be the most efficient. But notice that when the price goes up, if we can charge more for our product, we're willing to make more, right? Businesses are happy if they can make a good profit on their product. So as the profit margin increases, if they can sell their product for a higher price, they're willing to make more. But we have to recognize that as you produce more, what happens to the extra cost to make more? It goes up. We can even see here the average per unit cost goes up. And so if we increase our production, it does increase the per unit cost. All right, so the economic capacity is where we're most efficient, but if the price is higher, we're going to choose to produce more, even though it makes us less efficient because we want more profit. All right, let's look at some other terms. Like, where is break even? Where is it that you would not make any economic profit? Well, what if the price in the market was 30? If the price in the market was 30, again, we would produce more if the marginal benefit, the price of 30, is more than the extra cost, like all here. Where do we stop? Well, if the extra cost is more than the price of 30, we would want to make less, and we would stop where? We'd stop here where the price equals the marginal cost, where the marginal benefit is equal to the marginal cost. So if the price was 30, the quantity we'd be willing and able to produce would be less, okay? But we're still making profit here at 30. What if the price in the market was 20? Again, as long as the marginal benefit is more than the marginal cost. So for example, here is the price, here is the marginal cost. As long as the price is more than the marginal cost, we would make more. And we keep going. And we'd stop where? We'd stop when the price is equal to the marginal cost. So we'd end up right here at a quantity, what is that, just over 70. Now at that point, are we making profit? How do we tell if we're making profit? What does it mean to be profitable? We are making profit if the amount of money coming in is more than the amount of money coming out. So we want to look at our price of $20 for that 71st unit. How does it compare to the cost? Well, the extra cost to make that 71st unit is the same. That's why we stopped here. But what about the cost of all those 71 units? What are we looking at in terms of per unit cost? Well, remember, here is our average total cost, our per unit cost. So at a price of 20, if we're making just over 71 units, we're below the average total cost. So while the extra cost to make the 71st unit we might break even on, the problem is on average, the cost to make those widgets is more than the price we're selling it for. So all those first widgets up here, you can see the per unit cost is up there. So at a price of $20, we are not making economic profit. So where do we break even? Where is it that we are not making money or losing money? Well, that would be the point, because we're always going to produce until marginal cost, but that would be the point in which we're at the average total cost curve. So if we're producing until price is equal to marginal cost, and that puts us also on the average total cost curve, then that's going to be our break-even price. And here that's about $22. So prices below $22, like this red one we saw here, we're below the average total cost curve. We are losing money. Prices above the $22, like this one here, then we are above the average total cost curve, right? We can see that we're making profit. So the break-even price is the price at which we break even, that we're not making profit. And we want to kind of define a little bit better. So you can see here's that economic profit, and here is that break-even price. So notice that when we're looking at this idea of economic profit, it's not simply that it's this price here is the break-even price. Notice they're actually different between here and here, and that's because as we change the quantity that we're producing, it does change the per unit cost. So that break-even price happens at the minimum average total cost curve. If the price is higher, then you may end up at a point at which the average total cost curve has gone up, in which case when we calculate the economic profit, it's not from the break-even price, it's from a point above that. When we talk about economic profit, we need to differentiate between economic profit and accounting profit. So accounting profit, your total revenue is more than your explicit costs. You've paid everyone you owe, and you're making more money on top of that. When we talk about economic profit, you have paid everyone you owe, and you are making accounting profit. If you are now making economic profit, that means that the amount of accounting profit that you're making is more doing this than the next best alternative. So it already includes that opportunity cost. You can not have economic profit and still have accounting profit. So when we talked before about should you have a Subway sandwich shop or should you do oil changes, if the costs were the same and you've covered those costs, so you're now making accounting profit, the question is that are you making more profit running that oil change place than the profit you would make at the Subway sandwich shop? If you're making economic profit, that means you're making more profit. Let's say you're doing the oil change place. You're making more profit at the oil change place than you would at the profit at the Subway shop. So when you make economic profit, you're making accounting profit, plus you've been compensated for that sacrifice or opportunity cost. You're making more profit doing this than doing something else. And this is important because as we look at businesses' decisions to open and close, we have to consider, is this more profitable than the next best alternative? Because if you could make more profit running a different business, then you wouldn't stay in this business. So that's going to become important as we look at decisions and markets going forward. So when we talk about this economic profit here, it is an approximation to that profit that includes both the explicit and the implicit. But when we look at the graphs really are just made of those explicit costs, right? The marginal cost, the average total cost, average variable cost are based on dollar payments for factors of production. But we do want to recognize there is this difference between economic profit and accounting profit because it will impact the business's decision to be in the market, okay? And that will impact the prices and the quantities that are produced. So let's go back to our graph. Where are we? Okay, so we've talked about economic profit. We've talked about the break-even price. We've talked about economic capacity. And now we want to look at one last piece, which is the shutdown price. So here, this break-even price of $22, if the price falls below that, like this example we had right here at $20, we are not making economic profit. So should you shut down? Well, in the long run, if you're not making profit and you're not doing better at this job than you would at other jobs, you should get out and do something different. Now, if you are breaking even and you're making no economic profit, you could still be making accounting profit. So you could still be covering your costs. But what if you're not covering your costs? What if we have this price here at $20 and we can see we are below that per unit cost? So we're not covering all of the explicit costs. Should we shut down? Well, this is where we get into our discussion about the short run and the long run. In the short run, at least some of your costs are fixed. And what do we know about fixed costs? Let's go back to our graph. What do we know about our fixed costs? Even if you produce nothing, you still have to pay that fixed cost. So if you decide to shut down, we still have to cover the cost of the stapler. And so we need to consider that we can't just close our doors when the price in the market falls below our per unit cost, our average total cost. Because even if we shut down, some of the costs, the fixed costs, still have to be covered. So how do we decide if we're operating at a loss when we should actually shut down? Well, we have fixed costs and we have variable costs. Fixed costs we're going to have to pay even if we make nothing. So when do you continue to operate at a loss, at least in the short term, when you have the fixed cost? In the long term, the fixed costs are no longer fixed, and then you can decide to get out of this business. But in the short term, when you still have to pay the contracts, the leases, the rent, because you're contractually obligated, then you need to think about, can I put any of my money towards paying for that fixed cost? Can I continue to operate at a loss? Well, how do you decide if you should operate at a loss? Let's look here. What if the price in the market was $15? At a price of $15, you can't pay all of your costs. We know that because the average total cost is up here. Can you afford to pay your workers? Well, how do we figure this out? Which curve tells us about our workers? That's our average variable cost. So if the price is $15, we can't afford to even pay the workers. And if you don't pay the workers, they're not going to work for you. So if the price is at $15, we can't pay our workers, they're not going to make anything. We might as well just eat the cost of the fixed cost, the stapler, close the doors and go home. What if the price is $17? At $17, you are not covering all your costs. We can tell that because we are below the average total cost curve. But can you pay your workers? And how do we know? You are above the average variable cost curve, so you can pay your workers. So if you can pay your workers, then you could continue to operate, pay your workers, and then any pennies you make above the cost of your workers, you can help pay down some of the fixed cost. So you can take that fixed cost, like the stapler, and at least cover some of that $10. So where is the shutdown price? Where is the cutoff between we might as well close our doors and go home and eat the full cost of the fixed cost versus let's continue to operate at a loss and at least pay down some of the fixed cost? Well, that point is right here. So here we have our shutdown price, and it's about $16. So if the price falls below that 16, we can't pay our workers. We know that because the price equals marginal cost locations are all below the average variable cost curve. If the price is above $16, even by a teeny bit, we can pay our workers and use the extra pennies to help pay some of the average or of the fixed cost. To help us understand a little bit more about this idea of the shutdown price, I've included a video on a or about a movie, and that movie is called Hearts of Fire. So in 1986, there was a movie called Hearts of Fire that was released starring Bob Dylan, and you can see the trailer attached here. So this film was made in Canada. It cost somewhere between $15 and $18 million to make. Okay. Now, the film was released, premiered in London, and nobody came. So nobody came to see this movie. It was out in the movie theaters in London for 7 days. Nobody showed up. So they closed the doors and stopped showing the movie. It was never released to another theater. So let's assume you put that $18 million into making this movie. Okay, big cost. Okay, fixed cost. You paid it all up front, and now you're trying to distribute your movie. So you could have one person see it, in which case all 18 million of the cost would need to be in that one person's viewing. So can you charge someone $18 million to watch your movie? Or you could show it to millions of people and take that $18 million and divide it up into each of those people as you show it to them at the theater. Okay, now we got a decision to make. Do we put a bunch of money into more promotions and trying to get more people to watch this movie? Well, what do we know about sunk cost? Do you want to throw good money after bad? So should we put more money into this movie? If we couldn't recover our $18 million, should we put $10 million more into more promotion and marketing material? Well, we know sunk cost should not be part of your decision. Marginal benefit, marginal cost. Any cost incurred in the past should not be part of the decision. It's gone. It hurt, but don't throw the good money after the bad. So you're trying to decide what to do with this movie. Well, they could have put it in a dumpster and set it on fire. We know with our sunk costs, we shouldn't be pouring more money into it. So when are we better off just shutting the doors, going home, and no one ever seeing this movie ever again? Well, the question is can we release it for a price that at least covers some of the cost at least pay the actors, the staff, and then any extra money that we make could help pay down some of the bigger fixed costs. That depends on whether we can get a price out of it that is above the shutdown price or below. So this video, right, we decide, should we release it to VHS cassette, because this is the 80s, rather than putting it into more theaters, okay, because no one wants to pay that price. And rather than just burning it and no one ever seeing it again, if we can get it for a price that's just above shutdown, we can help pay down some of that fixed cost. And so that's what they did here. And you can check out the trailer. Is it any good? Is it a movie you've heard of, or something that you'd be willing to pay to watch? Is the price and the value to customers so low that it's not even worth releasing to VHS cassette? Or could we at least rent it or sell it on VHS if we couldn't get people to pay the price we need in the theater? One more thing on the shutdown price before we leave it is what's happening with oil prices. And as we look at oil prices, we have to consider that there's a shutdown price and a break-even price. So when we look at the price of oil, and let me see if I can get this to open here. So in Alberta, we care about the price of oil. And as we've been looking at the prices of oil, this is back from 2015. But in 2015, the price of oil started to fall. We were up nice at $100 a barrel, and it started to fall below 80. And this projection, which has turned out to be true, is that the price of oil would stay below 80 well through 2020. And we look at here is the price of oil. And it's important to know what the price of oil is because it impacts decisions that businesses are making in terms of the oil industry in Alberta. Should the businesses in the oil industry in Alberta, should they expand their business? Okay, so should we drill more and invest more in technology? Or should we continue to maintain just the oil production that we have? Or should we shut down? And this really comes back to that break-even and shutdown price. So if we can produce at $80 a barrel, we're making profit. It's above the break-even price, and we're able to keep producing and making profit. So many oil companies in Canada can continue their existing operations with lower prices. But the expansion, we talk about growing the production of oil, it needs that break-even price. It needs the price of oil to be about $60 a barrel. Once we get to about $60 a barrel, above that it's profitable and it's worth expanding your production. Once we get down to about $60 a barrel, you can still maintain your current operations and be profitable, but you can't do expansion. So as the price of oil drop per barrel, what we see is that we see less expansion, more just maintaining the operations. But when we see the price of barrel drop below about $30 a barrel, then we're starting to hit the shutdown price, where it is no longer financially viable for the businesses to keep in operations, even their existing operations. Now, different companies have different shutdown prices. $20 to $30 a barrel is probably about that range. But if the price of oil drops below that, then they're operating not only at a loss, but can't even cover the cost of their workers. And so as we look at the economy in Alberta and what the future holds for economic growth in Alberta, we have to consider what is happening to the price of oil, and is that price per barrel above break even? Is it above the shutdown price? or is it below? Because that's going to impact whether businesses will continue to operate and how much they're willing to produce. The last piece we want to look at is the fact, let's go back to our main busy, crazy graph here. I know this one's getting a little ugh. But what we know is that if the price was $35, you were willing to produce 110 units, you were making economic profit. When the price was 30, you were still willing to produce, you were still making economic profit. Same thing when we were looking at 27, and we were breaking even at 22. So we were able to produce at all of those prices, and we could find those quantities by simply going down and looking at how much we would be willing to produce at that price. We know that we're not willing to produce below the shutdown price, because at that point we can't afford to pay our workers. So when we're looking at how much we are willing and able to produce, we are willing and able to produce at prices equal to or above the shutdown price on that marginal cost curve. So what we've just found is the supply curve. It shows the relationship between price and the amount that businesses are willing and able to sell.